Greetings, listeners, and welcome to the Care Table podcast, dedicated to educating and supporting family caregivers of aging loved ones. I'm your host, Amy Huddleston. Through insightful interviews from both industry experts and family caregivers, we aim to provide valuable perspectives and resources. Let's see who we're learning from today. Hi, welcome to today's episode of the Care Table. Before we start, I do want to remind you, please leave a review, hit the subscribe bell on YouTube, just leave us a message and let us know how we're doing. We really appreciate you following the podcast. Today, we're going to talk about long-term care insurance. I'm excited to introduce our guest, Natalie Murch. And Natalie, I'd love for you to just start by saying, how long have you been in this industry? A little bit about your expertise.
Sure. Thanks for having me today. I actually started working with long-term care insurance products in the late 90s and started my own company, LTC Choices, in 2003. So this is all I've done for almost 30 years now. And I work with folks all over the country who are looking to become educated about what long-term care insurance is, how you might pay for it, what it covers, what it doesn't, when I should maybe look at it. So it's just so they can make an informed decision about whether this is something that makes sense for them.
Okay, great. So let's start then with what you're saying when you said you're good at educating people on what long-term care insurance is. Please explain.
Great. I think the easiest way to explain is to think of it as a bucket of money. I call it a bank account, a checking account of money that you are going to use instead of or in combination with your own income and assets that you have set aside for retirement or whatever you want to do at this stage of your life, to pay for any type of care that you might need from an extended health care event. And that can be something that happens as the general process of aging. It can be something that happens as a result of an accident, an illness, a fall, things that we can control, things that we can't control, but it's just a chunk of money that we're going to access instead of spending down dollar for dollar the money that we have set aside to enjoy later in life.
Okay, so it's called insurance, but explain to us how is it different from my Medicare coverage or my life insurance? How is it different than that?
From Medicare, that's a common question I get. How is this different from my health insurance or my Medicare, whatever my health insurance situation is based on my age? Because a lot of the things that people think about when they think about a long-term care event kind of overlap with health insurance. The easiest way, I think, to differentiate the two is to think of your health insurance, whether that's private health insurance or Medicare supplement, as those funds are set aside to pay for an acute situation. Something is broken and we're going to fix it. Where a long-term care event is a chronic situation. It's long-term. It's not going to go away. The other thing is your health insurance is designed to pay for skilled care. People who are providing medical care, doctors, nurses, people with initials behind their name. Most long-term care is custodial care. So it's not skilled care. So we have acute versus chronic. We have skilled versus custodial. The two don't overlap. And that is why they're not mutually exclusive. You need health insurance for sure. But you may also want to have some type of long-term care insurance.
So dig a little deeper in, I know custodial, but explain to listeners, when you say custodial care, what do you mean by that?
Custodial care is really the opposite of medical. It's somebody that could be coming in and doing things like personal care, helping with a bath, a shower, making sure somebody can get dressed without falling down, making sure somebody can move about their residence without tripping and falling. Things like cooking, cleaning, putting meals in the freezer for the days that there isn't somebody there with those people, doing laundry, changing beds. That's all part and parcel of custodial care and all part of what a long-term care insurance policy would pay for.
Okay, so that's helpful. All right, so let's dig a little deeper in the kind of services that a long-term care policy could cover. So you mentioned the custodial care, which would mean I hire a caregiver, for instance, that's going to come in and help my person, make a meal, get dressed in the morning, take a shower, drive them to an appointment,
those types of services. Is there anything else in these policies that, because what I would ask is, years ago when I opened my home care agency, I mean, this was 2004. I was really surprised that people that had long-term care insurance policies at that time, they pretty much only covered like a nurse in the home. So
Mm-hmm.
they've definitely changed over time. So help us understand, in addition to that custodial care that you're going to pay for a caregiver, are there any other services that some or all of these long-term care insurance policies cover?
Sure. Most of the care is custodial. However, it will cover a nurse, a therapist, an occupational therapist, a physical therapist when those things aren't covered by health insurance. So sometimes health insurance provides X number of visits, but when you're done with that number of visits, then you're paying out of pocket. If you have a long-term care policy, it will pick up the difference. So it pays for those. It also pays for care when you're no longer in your home, or if there's a situation where you still have one person that's working. A long-term care policy would pay for adult daycare. So just like little people daycare, if somebody needs to be, attended to during the day while the other person is working, then that is also covered by a long-term care policy. So really, there's a term called the spectrum of care. So a long-term care policy pays for everything from care that happens in your home, whether that's custodial, skilled, any of the things that we've talked about, or adult daycare, or assisted living, or skilled care, or memory care, any place that you choose to be, even hospice care, although that's oftentimes provided at no charge today, who knows down the road.
Mm-hmm.
And inpatient hospice care is not typically provided at no expense. So long-term care policy pays for that. So it's really that whole gamut of types of services and locations where care can be provided that could be paid for out of these dollars, again, instead of out of your own personal income and assets.
I did not realize about the inpatient hospice unit. That makes a lot of sense. So the hospice, I need to clarify for listeners. Hospice is amazing and they provide great services. We have an episode on that. But I think it's great for you to clarify, like you did, that typically they're going to come into the home. You get a nurse that's about an hour a week. You get a bathing aide that might be 2 to 3 visits a week, maybe for an hour. You get a
Mm-hmm.
social worker. So it's minimal care. It's wonderful care, but it's minimal. There are some hospitals or facilities that do have inpatient hospice units where the hospice patient can actually come for a stay, whether it's a respite stay or a longer term stay, if maybe they don't want to pass away in their home. So in those cases, is what you're saying, there are some of the long-term care insurance policies will cover that stay.
Correct.
That's great. Okay, had no idea. What about, we also had an episode which really surprised me, a geriatric care manager. So the geriatric care manager said some long-term care insurance policies cover that service. Is that usually included in the spectrum, or is it not always included? So you really need to pay attention to the details.
In current policies, the better policies, the ones that I would recommend to folks, there is almost always a care manager. It's called a care advisor, care coordinator, different terms for basically the same thing that you're referring to. Somebody that is there to, first of all, help certify that it's time for the benefits to be paid. And that's important because when people are in a situation where they say, hey, we think we need some help and we have this policy and we want to start to collect benefits, a lot of times the first thing they think is, I'll go to my doctor and, get some documentation. Not usually very helpful. It's not what, no offense to doctors, but it's not what they do. With today's documentation being even more limited, there isn't typically enough information to substantiate that it's time for the situation to generate benefits. So the care manager is kind of stop number one to say, yes, you trip one of the 2 benefit triggers in a long-term care contract, and we can talk about what those are. Once we say, okay, it is now time for the policy to pay benefits, that care manager's job now pivots to what types of services would be helpful to you. And their job is to make recommendations based on the evaluation of you, your surroundings, are there friends and family available, what would be helpful. You decide how much or how little of that you want to implement. And then the last thing is to match up for all of those services in your area where you're going to find people with, good ratings, people that maybe these don't have the greatest reviews. Again, not managed care, not in network, out of network, but it's somebody there to manage and monitor the situation, take all that off your plate, facilitate getting those dollars when it's time, so that you're not trying to do that in addition to being in the situation where you're helping a loved one.
I think that's so wonderful that that is included in the policies because it's also challenging, at least what I saw in at our home care agency. I felt a little bad for clients that had the long-term care policy who were able to go ahead and use it. They triggered it. Like you said, they're going to file a claim, they're going to start getting benefits. But the insurance company can sometimes require, the visit notes and the invoice and it's a lot for someone, let's say, who's 85 years old, who's had a little bit of a health scare, now needs the help to say, oh, hey, yeah, let me get my fax machine out and start submitting the notes so we would always do that on their behalf because we knew that that was something that was a little challenging. So we took that on, but I'm glad that these companies are realizing it's helpful for people to have an advocate like a geriatric care manager to say, I'm going to recommend what's best for them, as far as what their wishes are, what their care needs are, and then we'll make sure that the insurance company has what they need to move forward. So I'm very happy to hear that's part of the policies. I guess I would ask you, how long has that been, has a geriatric care manager been included in the policies that you're selling?
I think it depends on the company. The companies that have been doing this for a long time have always had that benefit in the contract, but I think the way that people use it and it's evolved into something that's even more helpful. And the other thing that they'll do, with my mother-in-law, which was probably the first policy that I ever sold, but also the first claim that I went through with a family member, finding the right caregiver is also sometimes a challenge. You know this from your background. But the care advisor was also pivotal in us making sure that we had somebody that was a good fit for her. So the first person that came, she was in her late 70s and they sent a nursing student. God love her, she was wonderful, but she was in her 20s and there wasn't a great fit there and a lot to talk about while she was there for 3 or 4 hours a day. So they worked with us. We ended up finding somebody who was much more of a friend, same age, much more in common. And so that's also part of what they do.
I think that's great. So it sounds like it's been around for a while, which is good. Let's talk about at what age or life stage should I consider getting a long-term care insurance policy?
This has changed quite a bit over my tenure with this type of business. When I started, I would talk to people, in their 70s. People still thought of this as an old age kind of planning tool. Then it kind of reverted back to people in their 60s. Most of the people I talk to today are in their early to mid 50s, late 50s. I think that coincides with a couple of things. One is retirement or pre-retirement planning, knowing what we need to have set aside for the various expenses and events that we're going to have in retirement. And I think the other is people being in a situation where they are either caregivers for parents, grandparents, or they're seeing what happens when there isn't a caregiver or money to pay for a caregiver for parents and grandparents. And the situation is, how do I make sure that I'm not in the same situation? I'm also even talking to some people who are younger than that, who maybe have been exposed to long-term care insurance as a benefit through their employer. And they want to look at, is what I'm being offered good? Is there something better? Should I be considering this in a different way? Another situation would be as people start to evaluate the other insurances that they have. I have disability income and it's starting to run out, or I'm aging out of it. What should I be doing instead with those premiums? Or I have a term insurance policy that I really needed when my kids were little and I had a mortgage and I don't have that need anymore. So should I be redirecting and looking at something that is more life stage appropriate? So all of that to say it's a much younger client than 25 years ago, which is great because the process of securing the long-term care coverage is certainly based on what you want to buy, what you're willing to spend, what you can afford, but more importantly, what you can qualify for. So health is an important factor.
Well, that was my next question is why does the timing matter when we talk to someone like you? So elaborate on that a little bit about the timing of, or just my personal situation. Why does that matter?
Your policy is certainly based on what benefits you want to buy. And I always tell people this isn't a one size fits all. It's not like I'm going to buy car insurance, I'm this age and I have this car and it costs this much. Really, it's more like buying a computer or buying a car. What do I want to have? Do I want, a Ford, a Lexus, or a Maserati? So it's based on your age, but it's also based on your health. So you can be willing to write the biggest check that we can imagine, but if you can't get past the underwriter's approval, then we can't get the coverage. And so the things that people sometimes in their mind's eye eliminate themselves, disqualify themselves, are often not what are of concern. What becomes an issue are things that are chronic in nature. Remember, we talked about this being chronic situations, not acute situations. So it's not always a life-threatening thing, like I've had cancer or I had, a heart attack, or I've had those types of things that people think of as major health events, and they are. It's more the things that are the general process of aging over time, chronic conditions, 2 or 3 things that add up together to be enough that maybe we don't get an approval.
Okay, that makes sense. So it does matter. I mean, obviously, how healthy you are. Kind of like life insurance, I would say, right? I mean, they're going to ask if you smoke and if you're, how risky you are and things. So it's similar that they're going to ask you questions that are appropriate to your health and your lifestyle.
Correct. But they're going to ask about things that pertain to your ability to do your daily routine and your cognitive status. So a little bit different. The major things, and when I start to work with people, the very first thing that I do is send a link to them, takes them to a brief online questionnaire. And that gives me a general overview of their health and the things that might end up being a concern. Height and weight, smoking status, medications, things like recent surgeries or physical therapies. So again, things that you have been through, recovered from, but are they going to be a recurrent situation? And again, really things that pertain to your daily activities, because that's how you qualify for benefits.
Okay. I kind of smiled when I realized because we went through this application, my husband and I, and I mean, I remember them asking the cognitive questions. You have somebody that calls you and they handle that. And I was a little stressed by that. I mean, because they're asking you to, they give you this list of words and then they wait and you got to go back and you have to answer them. And so I see what you're saying. Like they definitely test you on the cognitive side to figure out how alert you are. And that makes sense because I would say my assumption is at least half of the people that are using these policies now have some type of cognitive impairment.
I would say it's probably closer to 75 to 80% of people. And those cognitive claims are the claims that are longer in duration. And people typically don't recover from a cognitive episode, where maybe if somebody has a stroke and they need help for 6-8 months, a year, there's potential to recover from that. So they're very in tune with cognitive issues. That's not to say that, on that they give you 10 words and you have to repeat back so many words. They're not going to expect anybody to get all 10 words, but they're looking at things that could indicate that you're predisposed or closer to having an event than the average person in your age group.
In that age. So when you talked about what triggers the policies, can you dig a little deeper on that? When you mentioned maybe there's 2 different ways that you can trigger the policy. What are those?
Two different triggers. One would be the contractual wording is a severe cognitive impairment. It might be called dementia. It might be called Alzheimer's. It might just be, hey, Amy's getting older and somebody needs to be around to provide safety supervisory type of care. So that would be one way. The other, and I always tell people it's one or the other, not both. The other would be if you need help with any two of six, what we call activities of daily living. The acronym, and people might have heard this, is ADLs. Easiest way to think about that is, what did you do when you opened your eyes the first hour or so of your day? So those six activities are bathing, dressing, eating, toileting, transferring, and continence. So transferring is being able to, get up out of a chair without falling, move around your place of residence without having to, hold on to lots of things. The other important clarification is that the word assistance is defined in two ways in a long-term care contract. So if we look at bathing, that's probably the easiest one to clarify. You could need hands-on assistance with bathing. That means somebody physically needs to give a bath or a shower. More commonly, people need standby assistance with bathing. They can do a bath or a shower once they're safely in the bath or the shower. But what about getting in and getting out and not slipping while you're in, or even setting the water temperature at the appropriate level? So that's all part of assistance. So when you are deemed to need help with two of those activities or have the cognitive issue, and then the last piece, what defines it as a long-term care event, is that we anticipate you're going to need help for at least 3 months.
Okay.
So if either of those two situations is present, then we look at the policy and say, okay, Amy, you've got a long-term care contract. You're eligible to start taking money. Where do you want to be? And then we connect you with that care advisory benefit and start the ball rolling.
Okay. So what I want to ask you is, when you talk about the types of policies that you can buy, and you said you could buy, like I could get a Honda policy, or I could get a, nicer policy. Can you give us an idea of the range of, like, kind of what's the basic type of policy that you could buy, like least expensive versus most expensive? What's the range?
The range is really based on the total bank account of money that you're buying. We've got, what I explained to people, we've got some building blocks in the policy. The first building block is what you want your monthly allowance to be. So that's how much you're going to get coming in the door every month to pay for care. And if we look at what the cost of care is, there's a big range between somebody coming in a few days a week, a few hours each time into your home, versus being in a memory care unit 24/7. So the range could be, in today's dollars, depending on where you are in the country, anywhere from $3,000 a month to $10,000 or $11,000 a month. So we kind of look at that and say, okay, how much of a bite of that do we want to take out? How much per month do we want that allowance to be? And then we look at how much do we want in total in our bank account. And that's really based on how many years or how many months of care we want to make sure that we have covered. So a basic policy would be having something based on about 2 years worth of care. The bigger that bank account gets, the more we say, well, you might have 3 or 4 years of care. There are even some policies in some situations where it's really important to look at a lifetime and unlimited bank account. So if somebody came to me and said, in my family, we have a lot of people that have had dementia or any type of an illness where, Parkinson's, MS, where we know it could be a long time in that caregiving situation, then we would look at putting more money in that bank account or looking at those policies that have an unlimited or lifetime benefit.
How does inflation impact at all? Like, let's say, I got my policy 3 years ago. I'm hopefully not going to need it for, let's just say, like, hypothetically, hopefully 25 years from now. But does inflation or rising care costs at all, get it considered at all when you're looking at the initial bucket of money that I bought with my policy?
It should, especially people buying at your age. So this is kind of that's another building block. In the policies that we look at, we have how much do we want per month, that allowance, how much do we want in total, that's the bank account, and then how much do we want those benefits to grow. And so when somebody's looking at this in their 40s, 50s, even early 60s, we're looking at the cost of care today and knowing that we may not use this for 20, 30 plus years. So there is a provision in the policy that's called an inflation rider that grows that benefit. And it can grow at a rate anywhere from 1 or 2%. The most common today is a 3% compound growth factor. So just like if this were a real bank account, every year you have 3% more in your bank account to keep up with the cost of care. As people get older, we use some different methods to offset that, but it is really important because we know the cost of care isn't going to stay the same and it's not going to go down. And so having some growth factor, I think, is really important.
Okay, so that's helpful because I didn't know it worked that way. Are there any exclusions or limitations that are on policies or that people should look out for when they're shopping around for a policy?
In today's environment, it's a pretty level playing field with both the benefit triggers. Any true long-term care contract has to have those same two benefit triggers and the exclusions. So really, because of the underwriting or the qualification is done up front, there's very little that's excluded. There's no pre-existing condition. There's no underwriting that's done at the time of claim, like sometimes with old disability policies. Really, the exclusions are things related to drug and alcohol abuse, self-inflicted injuries. Some contracts exclude care provided by family members. That's another area where I've really seen a lot of growth in the market as people say, well, what if I wanted my family to be involved in caregiving? So now there are contracts that pay for what we call informal care, whether that's a friend or a family member or just somebody who, say, I know somebody who's a nurse that's no longer an active nurse, but does this on the side and they don't work through an agency. I could pay that person through an informal care or a cash benefit.
Well, I would have to say that probably ends up saving the insurance companies money because, the care is very, very expensive when you're looking at, like you're saying, a memory care unit, or you're looking at a skilled nursing facility unit, or you're looking at caregivers from an agency 24 hours a day around the clock. That can get up to $25,000, $30,000 a month. These are very, very expensive. And it sounds like the best thing I can do is, just try to estimate as far as, what would I be okay with? Would I be okay with going into a facility? If I'm okay with that, what would it roughly cost? And then hopefully when I'm planning on purchasing a policy, then I can figure out that's the amount that I really am hoping to go for when you talk about that bucket of money. So I think that's a good planning for people to use is just thinking that way about, are you adamant that you want to stay home? Are you open to going to a facility? Because the costs differ quite a bit in those. So it's something to really consider.
I think, though, today there's so much more care provided in kind of the interim, which would be assisted living. In older contracts, initially long-term care contracts were specifically to pay for nursing homes because we didn't have assisted living facilities and not many people received care in their home, or if they did, there was really nobody tracking it to know how much to pay for it. So now with having all of that under one umbrella in the policy, it really gives you the flexibility to say, to your point, yes, if I want to stay at home and I want to be at home 24/7, I need to plan for what that costs. But if I want to be able to at least start out in my home and know that as my needs progress, I'm still covered. If I need assisted living, maybe it's going to cost a little more. If I need skilled care, maybe it's going to cost a little more, but it's all covered under one big umbrella.
Like you said, the spectrum of care. Let's talk a minute about the waiting periods. So I saw different policies that we would deal with that people had, where sometimes they would trigger the policy and they would be able to get coverage within 30 days. Sometimes it was a 90-day. So explain to us that, what that means when we're talking about the waiting period of your policy.
I compare the waiting period to the deductible. Most insurance that people are familiar with has a provision where you pay a little bit and then the policy, whatever type of coverage it is, pays after that. The difference with a long-term care contract is it's not dollars, it's days. And it can be anywhere from 0 days all the way up to 180, even 365 days. So we'll talk about that in a minute. The other big difference is, unlike your auto insurance or your home insurance, where it is a per occurrence deductible, with long-term care contracts, it is one time per person per lifetime. So the very first time that you have a situation where you say, hey, we need some help, we're going to make a claim on our policy, you're going to go through whatever that waiting period is in your contract. If you recover and you're back to fully independent again, and you need help later, whether it's for the same reason or another reason, you don't have that elimination period or that deductible again. So the range, I would say the most common by far is a 90-day deductible. In some contracts, that's the only option. There are options to have 30 days, 60 days, which sounds great because you're going to spend less money out of pocket. The difference is, what do you spend in additional premium to pay for that? There are some contracts that have a 0-day or first day coverage, 0-day elimination period, particularly for home care. And I think that's a great feature because by and large, people start out, if they've planned, receiving care in their home. And then as things progress, maybe that doesn't work anymore. So being able to have coverage day one in your home, I think is huge. You have no out-of-pocket deductible. The other thing to look at is how the elimination period is defined. Is it a calendar day or what we call a service day elimination period? And this is a little bit technical, but basically a calendar day elimination period is preferable because what it means is, let's say January 1st is when one of those two benefit triggers is tripped. I have that cognitive issue or I need help with my daily activities. My 90-day window of time, my out-of-pocket, my deductible is whatever my expenses are in January, February, March. If I'm like a lot of people and I've got home care coming in 2 days a week, from January to March, I haven't actually paid for 90 days of care. I've maybe paid for 42 days of care. I've still met the elimination period because 90 days have gone by on the calendar. That's very different than a 90 service day elimination period where I'm going to say, Amy, show me 90 different checks that you wrote to a caregiver. If you're having somebody come in 2 days a week, that might take you 6 or 8 months of paying out of pocket before the insurance company pays. So it's a little bit of semantics, but when you're working with somebody that knows the difference in those languages, it really makes a huge difference when the rubber meets the road and what you have to spend first.
So, but that's something people should look out for so they understand, whether, like you're saying, it's the calendar or the service days. There's definitely a big difference. And to clarify, if I'm paying, like it's the deductible, if I'm paying for the service out of pocket, that is not something that's reimbursed by my long-term care insurance policy. Is that correct?
Correct. So you've got to satisfy that deductible before the insurance policy is going to pay.
That's what I thought. Okay. So, let's talk now about you and I were talking a little earlier about there's long-term care insurance policies, and then I've heard of some other options like a life insurance policy that could potentially pay for my care or an annuity. So, do you help people navigate that and figure out what's most appropriate? And also, what are those?
Yes. So long-term care initially was 100% what we call traditional or pure protection policies. Those are very comparable to your home, your auto, a term life insurance policy, where I have a contract that is going to pay money when one thing happens. I have an auto accident, my house catches on fire, I need long-term care services. If that situation doesn't happen, if I have a 20-year term policy and I'm alive on day one of year 21, that policy expired, nothing happened, nothing gets paid back. That's what a pure protection long-term care contract is. It's going to pay benefits if you need long-term care. If you don't and you're lucky and you died peacefully in your recliner at whatever the magic age is, you had the policy, but it didn't pay anything. That's still what a lot of people gravitate toward because it is the way to get the biggest bang for your buck. And I'd like to talk at some point about joint contracts or shared contracts with couples, because that really mitigates the possibility or the likelihood that you would pay and there wouldn't be some benefit paid back. So we'll circle back to that. The other type of contract that is becoming more popular because there are more of them available now are what we call hybrid contracts. Sometimes they're called linked benefit, asset-based contract, all the same thing. But it is basically a long-term care contract that has kind of a safety net, if you will, that if I'm lucky and I don't need long-term care, then when I die, what I haven't used for long-term care is paid out as a tax-free death benefit to my kids, my estate, my favorite charity, whatever it is, just like other life insurance. So when when I talk to people and they don't like the idea of, hey, what if I pay all these years and I never use it? Well, that is kind of what insurance is. But if you don't like that, then there are these other contracts that kind of guarantee that either you'll get some money for care, or your heir will get money for tax-free, just like any other life insurance.
Okay.
And then the annuity contracts are really a great option for people who, either based on their age or their health, maybe can't get one of those other two contracts that we talked about, but still would like to take money and leverage it into a bigger pool of money for long-term care services. So those annuity contracts definitely have a place in the planning world as well.
And how do they differ then? When you say you get the biggest bang for your buck, typically on the long-term care insurance policy, how does the annuity option differ from the long-term care policy?
The benefits are the same. It just, you don't end up with quite as much leverage on the dollars. So really what we're looking at in one specific market is for folks that have annuities that have, maybe they bought a long time ago and they have a lot of gain in the contract. The government passed, among other things, a provision that allows that gain to, the tax on that gain to be forgiven when the policy is used for long-term care. So sometimes it's just a matter of saying, hey, I have this kind of potential tax bomb that I would like to diffuse and make sure that it doesn't pass to my heirs with a huge taxable gain, or that I don't have to take the money out and pay a huge taxable gain. We can just do essentially a paper transaction and eliminate all that gain. So in general, there aren't as many decisions and levers to pull and to customize in the annuity contracts as there are in the traditional and the hybrid contracts. But for certain situations where the funding is really driving the planning, they're a great fit.
Okay. So, and it sounds, if you're saying that, does that mean it would be a more affordable option for families that might not be able to afford maybe the monthly premium of long-term care insurance?
I wouldn't say that. I would say it's more for people who have that asset that has been purchased in earlier retirement planning that's been growing over time. So typically the annuities are for older clients, either because of the funding source or because of their health situation or just their age. There is a maximum issue age for the traditional policies. And sometimes when people are beyond that, the annuity contract is a good option.
Okay, that makes sense. So, if I asked you the question of who would benefit the most from a long-term care insurance policy, how would you answer that?
I would say it would be people that have accumulated enough money that they have money that they want to protect for either their retirement or for a specific purpose, passing on to my kids, charity, etc., but not enough that they're fully comfortable paying dollar for dollar at the kinds of monthly expenses that we talked about. So it's kind of people who are in the middle. I have enough that, I'm not going to be going through a spend down and having Medicaid or the state pay through welfare for my care, but I don't have so much money set aside that it's not going to make me blink twice to, pay several $100,000 or more for care.
That's helpful. Okay. Let's see here. What about you? You mentioned joint contracts. Let's go back to the shared contract. So what do you mean by that? What is a joint contract?
A joint contract or a shared contract is the ability to cover two people, whether that is a married couple, two people who live together and share expenses, two sisters, any two people that aren't in a multi-generational relationship under one umbrella, or the ability to use each other's benefits. So if we go back to that bank account analogy, if I'm working with two people in the same household as a couple, we can set up a bank account for each person. If it's a shared contract, we have the ability to use each other's money. So the odds are that both people aren't going to need care at the same time, maybe not even at all, but we don't know who's going to. And so using the joint approach or a shared contract allows us to put less money in each individual policy, which ends up saving money in overall premium. And knowing that if I exhaust my benefits, I can use my spouse's or partner's benefits and vice versa. So it allows more flexibility, and it allows us to put in place two smaller buckets of money or bank accounts, and knowing that we have the ability to cross over and share those.
Did you say I could do that with my sister? You could do it with a sibling?
If you're living in the same household.
Interesting. Okay.
Correct. So I have done that. Actually, I did a situation where I had three sisters that all lived under this. The older sisters never married. They all lived in the same household, and we set up a policy where they all kind of had access to one big bucket of money. Whoever needed it had it. So what's great about the joint contract, in addition, the shared, in addition to the flexibility of knowing, all our bases are covered, is that our premiums are tied together as well. So there's a provision in most contracts that says when the insurance company is sending me a check for benefits, my premium stops. So I don't have to pay for my premium when I'm in that situation. If I have a joint policy, most of the time, both premiums go away, the entire premium. So we don't have to worry about anybody paying a premium. And in a lot of contracts, not only are we sharing the benefits while we're living, but at the first death, my spouse, my partner dies, whatever they haven't used in their policy transfers over into mine. And then I have that remaining benefit available to me as well. So it's a really unique way to maximize what we spend in premium, and also the flexibility in how the benefits get paid out.
Interesting. Okay. You mentioned earlier about there are people who maybe they self-diagnose and say, I'm not appropriate for long-term care insurance. So in addition to that, are there any other misconceptions that people have around this that you would like to say, are that you get a lot, that you hear a lot, that are not the case?
I would say the biggest misconception I get is how much long-term care insurance is going to cost. And I would say 9.9 times out of 10, when we get to the point, we've done the education, we talk about how the policies work. I've shown folks some examples of here are some ways you could structure this policy. The comment I get is, wow, that's not as much as I thought it was going to be. I think people have in their head that long-term care insurance is outrageously expensive. I can't afford it, and I'm just going to have to take my chances, or set aside money and pay for it out of pocket. And I will tell you, you could certainly make a long-term care insurance contract very expensive. But if you work with somebody that knows how to use the different features and really maximize, and also understand that in most situations, we're not looking at this policy to pay for every dollar that I might spend on long-term care. We're looking for it to really soften the blow and to give us a fund of money that we can go to first if we know we're going to need to liquidate, whether that's real estate or sell stocks. We don't want to have to be spending money in a crisis situation when timing is bad. So even if we just implement a smaller policy that gives us kind of that cushion that we go to this money first and then do whatever we need to do when we know what the situation is and what it's likely to look like and how long it's going to last, just gives us an extra fund to go to first.
I would just say, and Natalie is not paying me at all to say this, but I would say in the 20 years I worked in home care, it was shocking to me at how so many people's lives changed in an instant. And you really are not promised tomorrow. You don't know what's going to happen. I saw firsthand how expensive it can be. And, that's why I looked into it, because I thought it's not something that people want to talk about. You don't want to plan for it. You don't think you're going to need it for a long time, but you don't know, and you really don't know. So I would absolutely encourage people to talk to someone, at least just have the conversation, get a quote, see what is available to you, because just like you're sharing, you might be pleasantly surprised that it's not costing you near what you expected it to. And it gives you some security to know that if something were to happen, especially, younger than you expect it to happen, that you've got a little bit of cushion. So I would really recommend that. And I would ask you, so do you allow, can people contact you that live in any state to purchase a policy, or is it specific to a state that someone has to work with, someone
No.
from their state?
No, I work with people all over the country. So The only thing that really is state specific is what the cost of care is in the state that you plan to reside in now and down the road, because there are some differences. If you're in New York City or, downtown San Francisco, you're going to pay more for care. So we want to structure your policy appropriately. But other than that, no. I do virtual meetings with people, all time zones, all over the country. The education first, and then kind of go through, here's some good, better, best approach of some policies that you might want to look at, and find out if it's something that makes sense.
So we'll be sure to include the link to your information in the podcast show notes. And if they're not reaching out to you, is there any website people can go to or anything like that that's far, maybe is there a national organization or something that allows people to search on finding someone that can sell long-term care insurance?
Unfortunately, there's really not a great website. Some of the bigger insurance companies have websites. Mutual of Omaha is one that has a pretty good consumer website. They won't ultimately direct you to a person, but there's some good generic information. AARP used to have some information. I'm not a huge fan of what's out there at the moment. And a lot of financial advisors that I work with, that's a big source of where my clients come from, is the financial advisors and investment folks have over the years come to realize that this is a good planning tool. So you might want to talk to your financial person and find out if they have information or if they have somebody that they work with.
That's really helpful. Natalie, is there anything else that you would add to tell anybody about long-term care insurance?
I would just say it's important to get educated and make an informed decision so that you're not making a decision in crisis mode. And I think for a lot of people, insurance in some fashion is a great idea. It's not for everybody, but work with somebody who can really be independent and have multiple contracts and products available to you that will take the time to give you the full education and let you make that decision that's best for you.
Thank you. This was very educational. I appreciate it. And I'm just going to say one more time, people, at least just ask, do the research, ask, get a quote. It's, there's no harm in doing that. You don't have to move forward, but you might be pleasantly surprised at just the security that can give you for not as much as you're anticipating and spending. So I will include Natalie's information in the podcast show notes. I so appreciate your time today. Thank you.
Thanks for having me, Amy.
That's a wrap for today's episode of The Care Table. Thank you so much for joining me. If you found this information helpful, would you subscribe, write a review, or share this episode with someone that you feel could benefit from hearing this information? I'd sure appreciate it. If you learned of anything during this podcast as far as books, resources, or products that you might think are helpful, be sure to check out the podcast show notes for links to access that information. A friendly reminder that this is not medical or legal advice. This is just information. Consult a professional for your own personal situation. I ask that God would bless you with the wisdom, the courage, and the strength that you need as you're navigating this caregiving journey. And I want to remind you, you are not alone. I appreciate you joining us today. And until next time, stay strong, and I hope to see you at the Care Table.